Well, I think there have been a couple of significant developments in 2012. One is the recent promulgation by the CIRC that will allow some of the China insurance companies to start investing in offshore funds. This has been something that I think has been long anticipated, but given the 6 trillion RMB worth of potential investments that the China insurance industry represents, and assuming that somewhere around 10% of that amount of money may be invested in offshore funds, it does represent, I think, a significant fundraising development for buyout funds and other international funds looking to raise capital. So I think ultimately it's going to represent $10 to $20 billion of available capital that could be invested in the relative near term. There's been some recent cases in China which have overturned contracts that provide for variable or contingent consideration being paid to private equity funds that are looking for an IRR return on investments in China. Obviously, MOFCOM and other regulators have been somewhat skeptical of contingent consideration in deals in China, particularly transaction agreements governed by PRC law. But there's been no formal decision made by courts that any of those provisions are per se legal. However, there have been a variety of cases at from fairly significant appeals courts in China overturning those agreements. So I think if you're an investor in China onshore looking at doing a domestic deal and you have contingent consideration there, which ultimately the target company is seeking to challenge at some point, it certainly gives investors pause as to whether or not a court would deem those provisions to be enforceable. So I think it puts an emphasis on looking to potentially structure the agreements offshore, looking to have them be governed by law other than PRC law. But that's something that we'll need to keep a close eye on. Well, there's no doubt that the trend is continuing. The trend is, frankly, in almost its second anniversary. We've seen over 30 take-private deals involving Chinese companies that are US listed. There is a definite clear roadmap now, both for offshore companies and US incorporated companies doing take-private transactions. But there are still a significant number of US-listed Chinese companies that I think we will continue to see looking to do take-privates. And we've certainly seen the trend in our practice continue this year, and interest for those deals continuing through the end of this year. The fundamentals for why those deals are getting done remain, which is poor trading in the US, low liquidity, very sour investor sentiment with respect to Chinese companies, poor analyst coverage, but ultimately it's really the discount with respect to the trading values of these companies compared to some of their Asian peers. Well, I think financing has always been a challenge, both debt and equity financing. I think that continues. The deals are still getting done, financing is still there, but valuation is a key issue. I think the banks funding the leverage have raised the bar in terms of what they're expecting in terms of financial performance. And I think the connections that the consortium has and the founders have with particularly the PLC banks is going to be an important factor as to whether or not that financing is available. Another issue is that a number of these potential take-private candidates have significant VIE structures because of the foreign ownership restrictions with respect to the industries. To what extent antitrust approval is required in those transactions raises a question about whether or not MOFCOM would ultimately provide approval or even indeed accept an application for antitrust approval. A number of, I think, buyers are would obviously want to seek to obtain antitrust approval to the extent it's not forthcoming because MOFCOM or other regulators don't want to explicitly or implicitly endorse the VIE structure, does raise an issue.